Happy Thursday. Welcome to Trading the Trend. My name is James Boyd. Alongside me, my good friend Brent Moore is in the chat. You'll see his initials, BM. We'd like to welcome Sharon, Dom, Frank, Naresh, Art, JP, Elena, and many others. Silas as well. Hello to you. Let's go ahead and hop right in. Today's date, July 31st. Just kind of a quick announcement. So I will teach with Kevin tomorrow on Friday. I will teach on Monday, this coming Monday. I will be out Tuesday and Wednesday next week. So I will post who will be teaching those sessions on X. You could follow me right on X, and you could just type in that handle at James Boyd CS for Charles Schwab. Just want to give you a quick heads up there. So some of the things we talk about is going to kind of be with the idea of kind of preparing for that I'm going to be out Tuesday and Wednesday next week. My son is coming home from Ecuador. It's been a couple years. So I'm going to spend a little time with him, probably be on the golf course a little bit. So we'll have to wait and see. Now, so some of the things we talk about are going to kind of be preparing for that. And sometimes in your life, you have things come up, maybe a vacation, whatever. And so you might want to try to prepare a portfolio if you're not going to really be watching as much. And so we'll talk about that here today. Now, also, we got some questions that came in the chat, so we'll make sure we focus on those topics. Our questions maybe regarding Microsoft's earnings gap, Meta, and so on. We'll get into those. Now, remember when we talk about stocks, not everything we talk about is options. Some of the things we talk about stocks, but also we look at options. Remember the options we cover would be like covered calls, cash secured puts, right? Those can be freaking topics or strategies. Also like verticals, occasionally callers and so on. But kind of like those main option type strategies. Nothing too advanced, but kind of some income and probability based examples. Remember that options are not suitable for all investors. When we talk about examples, they are just that. We will look at the paper money software application for educational purposes only. It doesn't matter if you're trading real, if you're actually looking at new products, you like to actually use paper money as a way to kind of practice. Are you understanding how that product works? Would that be something you would consider for yourself? Remember that investing involves risk, including loss of principal. And also remember that some announcements, if you go to schwab.com, so we actually have online courses, we have webcasts just like this. We also have in-person events. If you went to schwab.com/events, you could actually see the calendar of other events that could be coming to a city near you. Some of the ones we want to highlight are the upcoming Market Drive, a one-day event at the Gaylord Texan on September 20th. We also have what's called a Market Drive as well in Chicago at the Renaissance Schaumburg. Okay, and also that just kind of reminds me, the Northwestern football team stays there quite a bit, and that they might be there. So anyway, had a fun time with them last time. And also remember the October 10th and 11th. That's a two-day event at the Orlando World Center Marriott. How much does it cost? A round number of zero. Okay, so zero. It's really just investing your time, and we want to provide a different way to learn, which is an in-person. Also allows you to meet other people in your local area, so check it out. So if you just said, where do I find more information? Go to schwab.com/events. You can see more information and register. Now, just real quick as we hop right in, want to give us kind of some just quick updates before we look at the markets. This is going to take us to this page. If you have not subscribed already, simple. Just click on subscribe. All you got to do is click with one finger. Now, the reason I want to point this out is some of you have asked me about kind of after hours activity. We've been talking about earnings quite a bit, right? Well, one of the nice things about when you subscribe for free, you're going to see that there's a little hour, the little kind of search, okay, magnifying glass. And if you just typed in, let's say, after hours trading or anything that you said, hey, now what it does is it takes our channel and it's really looking through anything that we've taught. So if I said after hours trading, press enter. And what it does is anything that comes up with after hours, etc., comes up. I want to kind of point this out because if you didn't see Microsoft and a couple other stocks yesterday, man, there's some opportunity there, okay? This one would be one that I would say absolutely if you said, I don't know anything about after hours. Okay, what's the pros and cons? Watch this, okay? That one right there, let me actually just bring this up for just a moment. And there we go. And I'll put that right there. So just make sure. So if you ever had questions on, hey, I'd like to learn about XYZ or whatever, type it in. You can, again, if you subscribe and you type that in the search field right there, it's going to comb through our channel of any material that was taught right there. Okay. Now, I also want to kind of bring up, last but not least, if we bring this up right there, you're going to see this is the playlist for the channel, playlist for this class, excuse me. And the last one we talked about is really the potential catalyst for trending. And we talked about kind of mastering the 7 key strategies, etc. These have been some of the last couple weeks. How does an investor trade trend? 1, 2, 3 pullbacks catching momentum. These are the last 4 weeks of what we talked, okay? Now let's kind of get into kind of the meat of what we'll discuss here today. And first off, I want to kind of just say, if we look at, let's say, the SPX, and we'll look at kind of the graphs, and then we'll also look at the numbers. But really, when you look at before we talked about tariffs, okay, we're about 10% higher than where we were before that, okay? Let me actually take that back. I want to verify that. Let me pull one thing up, just make sure. If we go back and look at that, 10%, no, yeah, 4.5%. So we're 4% higher than where we were before the tariffs. Now, if we take it from, for example, the body of the candles post the tariff announcements, you're talking about 29%. Okay, so 4% before the tariffs, 29% pretty much from the bottom. We're talking about the closing. And if we go back and look at kind of the percentages, here we are on July 31st. I know what you're doing. You're looking at your income statement. You're looking at your balance sheet, right? At the end of the day, at the end of the month. Now, if we take a look at this, I just want to kind of point something out. This is year to date for just a second, okay? Gold year to date, 25%. SOX is 12%. We actually see NASDAQ at 11%, S&P at almost 9%, Dow Jones sitting here about 4.93, etc. Never a bad thing to actually see the VIX in the red, okay? So not bad returns through 7 months. And the question is it done, or could the trend continue to trend? Now, by the way, you might be thinking, geez, where are you? Where are you so far for the year? What type of allocation have you been having? Is it stocks? Is it options? Is it a mixture of stocks and fixed income? What do you got? If we actually look at, let's say, sectors just real quick, what's been kind of leading the way when we talk about the month end? If we're talking about for the month, if we actually take a look at what's been leading for the month, it's loading. And if we take a look at this just kind of year to date, as that completely loads, there we go. Well, here's month here. Here it is now. Utilities, okay? Now, can anyone name the 2 stocks we talked about in utilities yesterday? Any takers on that? Type those symbols in. Which stocks were they? Now, a lot of people say utilities are boring. It kind of depends. How much money do you have? Okay? You might have some bigger positions. That bigger position might lead to a bigger potential dividend. Dividends are not guaranteed indefinitely. They could go up, keep the same, cut them slightly, cut them completely. We know that's a risk to dividends, but utilities, they don't look like they're playing around, okay? So keep an eye on those. We'll pull those up in just a sec. Technology, 4.5%. Energy, 3.22%. 3%. These are the sectors, okay? Now, what's kind of amazing when we take a look at this quickly, when we talk about, let's say, year to date, it's industrials, okay? Caterpillar, meow, okay? When you actually take a look at, obviously, technology, 14%, SOX, there's utilities. A lot of people think utilities is boring. Well, I don't know. I mean, would you give back 12%? I mean, think of it like that. Communications, 10%. Now, financials, 9%. Not bad, okay? The only one that's really down mainly is healthcare still, and transports are a little bit underwater, a little bit. Let's pull these up and kind of see what these look like for just a sec. By the way, the S&P actually made a brand new high. The NASDAQ, for example, hit a brand new high. We'll talk about some of the stocks that actually led that, okay? And you're going to take a look at the Dow Jones. It's not breaking out. The keyword is yet. Could it? And if we look at the Russell, not following through on the breakout. Matter of fact, kind of broke out, and it did. and it just kind of failed, and it's actually pushing down. This stresses what we've been talking about for weeks and months on end. In a more unknown economic environment, if you had to pick the battleships of large caps or the small caps, which is potentially equivalent to a kayak or a canoe or a rowboat in choppier water, if you've ever been on a lake or the ocean, some investors say, look, forget that. I'm going to go something that actually has some bigger side of the hole, so to say, where I could try to take or withstand choppier seas or waves on the lake. Small caps still underperforming, but it also kind of goes back to what revenues do these smaller caps have compared to these larger caps. Speaking of that, we're going to hop into Microsoft in just a moment. When you look at, let's say, communications, if we take a look at communications, what you're now going to notice, if you look at IXC, Charter Communications drove that down. By the way, Charter is still dropping, okay? Charter is one of the stocks that is in that neighborhood of communications. It's actually shocking that communications is maybe trying to get a little bounce here. Shocking. When you look at utilities, okay, that is grinding to the upside. That's a little higher low, trying to get a little crossover itself. And obviously, if we go back to the question that was asked, which two stocks we talked about yesterday that the investor might want to keep an eye on, we said Constellation Energy, which had a little push here today. That's what it looked like yesterday, gapped to the upside here today, okay? The second stock, what was it? NRG. That's the other one we said, hey, could this be kind of more of an intermediate breakout, okay? And we actually have earnings coming up on that. It did actually gap up a little bit, rallied to about 169. We're going to keep an eye on those, okay? But let's kind of actually talk about some of these trends here. Now, first off, why are we going to talk about Microsoft? Simple answer, because it's in the portfolio, okay? Now, the portfolio that we're talking about is a paper money portfolio, simulated trading. It's not real. Now, what you're now going to notice is we're going to bring up the position. What is the position? The position is 14 shares of stock. 14 shares of stock were purchased at or on 529. So it's been about 2 months or so, okay? About 2 months. Now, the position currently, before we look at the chart, it's up $1,075. Now, you ever heard anyone say, you know what, money doesn't buy happiness? You ever heard anyone say that? Then you wonder who's paying their bills, right? So, I don't know, does money buy happiness? You decide, okay? Now, if we go back to kind of this, let's imagine that we said we took that Microsoft trade out. And instead of the portfolio being about 112,829, that it was sitting here about 111,700, okay? So this one trade that is up about 1073, has not realized it yet, it's unrealized, that moved the portfolio 1%. These 14, that's funny, 14 shares, it's not going to do squat. Well, it's up 1,000, it could be down 1,000, right? So a lot of times people look at these 14, 7 shares, 9 shares, whatever, don't think it's going to do nothing. Well, I don't know. It moved the portfolio. It's up 1073. If we back that trade out from where the balance is now, it'd be 111,700. And then it moved the portfolio. These little whippy set 14 shares, 1% of the portfolio value. Okay? Don't laugh. We said not to laugh. Okay? Told you. Okay? Now, it could have lost too. Okay? In this case, the trend is up. Now, the question now becomes, let's talk about the trend. Let's talk about the price action so far. What might the investor consider now? Well, first off, I want to go back to a chart, and forgive me that I updated this chart. Okay? What do you mean by that? Now, we're going to call this the rainbow chart. We haven't, this is probably the least used chart that we've talked about historically, but I did add it to the package, and I'm going to resend that out to you. Forgive me, okay? But it's probably the least used, okay? So the blue line, what is the blue line? It's the 10-period moving average, okay? Fine. Now, if we look at the yellow line, What is that? That is actually, we could verify and confirm that. Right click on that line, edit study. What is that? Well, the line, so we're using the 10 period moving average, and it's 3% above. Okay, so 3% above the 10 period moving average. Okay, so the yellow line, 3%, and just so there's no confusion here, I'm going to hurry and type it in. Okay, and I'll put that right there. That's 3%, 3%, and I'll color code that so we can see that. So that's the 3%. That right there, if I right click on it, that's 5%. We could see that right there, and it's using exponential to do that. So I'm going to put 5%, so there's no confusion. So I want to ask you a question. Why did Microsoft sell off? Why did Microsoft, despite the good earnings, why did it sell off? And what does it have to do with these envelopes at all? Okay. Now what you're now going to notice is, I believe that white, the way when we set this up, yep, 7%. So what happens is when you start getting north, so before I even ask this question, go back and look at the number of times the stock was able to get above the 10 period moving average by 5%. Let's go back and look at lately. How many times did the stock get above the 5% line, that red line? The answer is not many times, okay? When it did get above the 5% line, it was about right there, and it kind of drifted, allowed the moving average to catch up to it, and then it started to grind higher. We talked about that. Go back 3-4 weeks ago on the playlist. Now, why did it do this? Well, sometimes what happens is people did not probably buy Microsoft just to have a ticker symbol, okay? They bought Microsoft to try to make money. When you get so far elevated off support, 3% is not really elevated. It's close to the support, potentially the support being the 10 period moving average. And the 5% gets elevated, and 7% is like someone screaming, la, 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 okay, and literally saying, hello, profit taking, okay? Because if you buy this thing 7% off the moving average, the likelihood that it's going to come back down becomes a lot higher. Today, the price actually opens above the 7% line, and what do traders do? Just as we would expect, they'd sell. It doesn't mean that they hate the stock. It doesn't mean that they don't want to keep some of the stock. It doesn't mean that they'll rebuy it in a couple days. But they took the pop and said, spank you very much. Now, let's go back to just real quick, and I'll share this chart in just a moment. Let's go back to this chart right here, okay? These are looking at the stops, okay? Now, the thing is, if we look at the stops, we can move it up just a little bit, but we're going to need a couple days of that stock kind of consolidating. If this stock consolidates over the next couple days, we can move it up. But a move in that magnitude is massive, okay? Now, for some of our fundamental friends out there, I do think it's actually worth, when you look at a stock like Microsoft and you take a look at, let's say, the sales, okay? These sales, when we're talking about on a company like Microsoft, they're not small, okay? Sales per share at 32, earnings per share has doubled over the last 5 years from 576 to 1180. You're talking about compounding annual growth rates actually reaching 20%, okay? We're talking about a company like Microsoft. The reason why I point this out is this is what the goal of riding the trend is, to have some fundamental factors or foundation and then trying to ride that trend and let it rip. And the key is move out of the way so you're not your worst own enemy, which we all have been for each other's trades. In terms of you trade for yourself, and sometimes you're your worst own enemy. I'm my worst own enemy. Sometimes we can't believe it keeps going up, but that's kind of what sometimes the tailwinds do, okay? So on Microsoft, I just kind of wanted to point that out. Let me send this chart to you and we'll move on. But if we look at, save that grid before I send it. And these are some of the package of the charts we actually use, or settings. And I'm going to send it to you. And it has that chart on the right-hand side that we added, okay? Now what I'm going to do is I'm going to send this back in. Yeah, now what I'm going to do is let's kind of go back to something for just a moment. I want to kind of look at it just a couple stocks briefly before we talk about some new ones. So we got AEM, which is what type of position is it? AM is a gold stock, okay? Sitting on 435. It's sitting in trend number 4. Now, when I see trend number 4, what type of strategy are you thinking? And by the way, we could also point out the whole moving average for the last 4 days has actually been dropping. What type of strategy do you actually start to think of? Going bearish? No. Iron condor? No. Okay. Collaring? Could. Okay. It's more defensive. Okay. But when then we get into trend 4, we're kind of thinking maybe about cover call, especially if we have, let's say, 100 shares of stock. Now, here's what I want to do. On the positions of NEM, which, by the way, NEM is showing the same, right? Trend 4, trend 4. So without even looking at these, I'm thinking, hey, could we do some cover calls on these? Maybe as I'm gone next Tuesday and Wednesday. Let's do this just real quick. Now, remember, when we do like a cover call, the whole goal of actually that cover call is we're trying to go out 20 to 50 days to expiration. Why? Well, we don't want a long duration because I don't want to lock the trade up indefinitely, okay? Just short term so that actually the time decay can bleed faster and faster and faster. Now, the biggest also thing is I want that time to go against the buyer and potentially a plus for the seller of the option who owns the shares of stock. So what we're going to do in this example is we're going to sell. Now, you might say, James, I'm confused. What is this position down here? That's a cash secured put, okay? That's the shares of the stock. So what we're going to do is we're just going to click on the 135 call. So on AM and NEM in trend 4 up near an area of resistance, we're going to actually say, look, can we sell the call? When we sell that call, we're trying to collect some premium. The premium is potential income. We need to see what the stock actually does. We haven't gained that, but that money goes into the account, and then over time, we're going to see it. Can we capture some and or all of the position? So trade number 1 we're going to do here on AM, we're going to sell a call. What delta was that? The delta on that trade on the September 19th, 135, it has a 29 delta. Now, James, that's a little low. That's on the lower end of the range we talked about, a delta of 30 to 40. That's true. If you sell something like a delta of 29-ish, you're trying to really have a higher potential upside on the what? The stock. If you want to be a little bit more protective, the investor says, I'm going to sell the 130, okay? Now, the 130 still gives upside, and you're going to see if we sell the 130, it's a bigger premium. So I got to ask you a quick question. How many of you would sell the 130, and then how many of you would sell the 135? Now, if we go to 135, it's in the range of delta 30-40. Greater chance of expiring the money, hence bigger premium. I'm going to leave it up to you in the chat. How many of you would sell the 130, try to get a bigger premium, be okay with actually maybe being assigned, or selling the 135 having higher potential upside on the stock? Well, if we take a look at this, what you're now going to notice is we're going to go to, now, okay, so Lisa says the 135, David says the 135. Man, everyone's saying 135. Can't even get it at 130. AP 514, fine, thank you, okay? Now, what I'm going to do is I'm going to try to sell it at 262, which is in the middle between the bid and ask. Confirm send, send the order. Now, let's go back to the chart for just a moment, and I want to see what that chart looks like. So this is what the chart looks like. Would you say that this is kind of starting to form a level of resistance? I think you could probably say that. Do you think that maybe, for example, if we look at the earnings, that actually happened this morning? We could have even tried to sell that before, maybe when the volatility was higher. Higher volatility, bigger premium, lower break even. On NEM, what this looks like, it's the same type of idea. We're seeing in the shorter term, the price pull back a little bit. Now remember, when that price pulls back, some investors, what they do is they say, look, if I start to see that 10-period moving average starting to go red, let's try to sell a call against the shares that I have. On NEM, how hard is that to do that? Well, let's pull it up. Let's see if there's any liquidity. On NEM itself, pull up the position. Same thing here. What is this position? Well, that's kind of more your cash secured put. It's really short, wide put vertical. There's the shares, which, by the way, is not bad profit, $1,100, 1% of the portfolio value. If we go to September expiration, Now what you're going to see is if we went a delta between 30 to 40, which is the probabilities of the stock being above the strike price by a penny, that's 171. If we got something in the middle, it's going to be about 173. So this is a directional strategy, but we're kind of counting on that maybe that stock might consolidate and or pull back a little bit. Now, what happens if you're wrong and the stock closes above the 160, closes above the 65? You get up to the 65, but you also get the premium on top of the up to the 65. So we can make from 62 to 65, which is $3, add the $1.75. So it's like making $4.75 more than where it is now. $4.75 more on a $61 stock, that's like 8%, okay? Now, how greedy could the investor be? And the answer is a lot, okay? So don't say we're capping out just 2% higher. It's another 8% on top of where the stock is now. So that's the first thing I want to kind of do. Now, when you look at, let's say, the AM and the NEM, we switch those to actually a covered call. And we'll put those right in this section down here. And I'm going to kind of make sure that you put them there. I like to categorize them, okay? I don't want to look at these positions and say, what type of position is it? I'm going to make sure that these are now covered calls. So now if the market becomes more volatile, I say, okay, which ones are unprotected or just stocks by themselves? And then which ones are more income strategies, covered calls? Which ones are more protected like collar and so on? Now, what I also want to just do real quick is let's kind of talk about a new example. And I want to go back to the question that was asked on Meta, okay? Here it is. Now, when we take a look at Meta, we pull this up, click on those three lines, and we go to maximize sell, okay? Now, we see that Meta had a pretty big pop to the upside. Now, one of the things I like to look for is I like to look for companies that are making large capital investments. The capital investment, they're taking savings or borrowing money, and they're trying to create new products and services that might create future revenue and or earnings. The bigger the CapEx, the bigger the potential change in revenue and earnings could be. Meta being an example where they've spent billions, B for big, and they've actually had some return of that investment. Well, if we look at, let's say, Meta, it's up $80, 11%. Go back to the three-year weekly on this. This is what it looks like. Now, if you go back to this chart, we've always been kind of talking about a lot about V patterns. When you get these V patterns, these could be some of the most lethal upside moves. And people will say things like, I can't believe it, I can't believe it, I can't believe, how does it keep going up? Well, it's a simple answer. There's more buyers than sellers. And the other thing is, over time, if the company is cranking out more revenue and earnings, the price hitting a high is not necessarily completely shocking, okay? Now, let's say the investor said, look, James, I think this stock potentially could go higher, okay? And let's say the investor says, it's a $775 stock. Let's say they decide, look, I want to try to be on the selling side of the trade. What's kind of interesting here is you're going to see that this has an implied volatility of still 35%. Now, this is kind of interesting because isn't the VIX at 15? Didn't they just announce earnings? And the implied volatility is still that high. So that's kind of interesting. Now, if we pull this up, we're going to go to September, 19th September expiration. And if we said, James, I want to kind of do this trade, but I want to kind of be a little bit more conservative. Conservative means selling farther out of the money. Conservative actually means selling a strike with a lower delta. Okay? Now, when we talk about delta, we're saying probability of closing below that strike by a penny. And I'm talking about on the put side, okay? Now, the delta is also saying the rate of change. Stock moves $1, the option moves by approximately 29 cents. Okay? So think of rate of change. Or I like to think about it as a conversion. Stock moves $1, The options theoretically move by conversion 29 cents. Okay. Now, if we take a look at this, so we're going to go to the 740 and we're going to kind of look, just verify, is there open interest here? Where is there more open interest? I got 35 cents there, 30 cents there, 25 cents there. What we're going to actually look to do is we're going to look and see if we can't do the 735, 725. Now, if I right click on that 735, sell vertical, okay? Now, if we did the 735, 725, assuming that we could take that risk, you have a $10 wide spread, 245 credit. And that tells us we have 755 in terms of the max loss. Now, if you take a look at that, you got to ask yourself, are you or could you take the risk of 755? I want to talk about a bad trade here in just a second. And sometimes bad doesn't necessarily mean horrible. It doesn't mean, my gosh, I've lost all my confidence. Okay, I'll show you that in just a sec. But could the investor, if we lost 755 of a portfolio that's sitting at 112,368, that would be about, let's just round up, 0.01 would be 1%, 0.0067 is really saying 0.7%. So if we lose on the trade or let's say we lose all of it, it's like losing 0.7%. Not going to probably be life-changing, okay? Now, what we're going to do is we're going to send that order, and now what we're going to try to do is when we look at that break even, it's just going to be the strike that was sold less the premium. Double check me on this, but I think that premium was what? Right at about 240-ish? So that break even at expiration is right around 732-ish. That's keyword is at an expiration. So that means the stock could come down from 775 down to about 732 and still be above break even. Anything lower than 732, it's starting to be below the break even and the losses could become more and more severe, right? Now that doesn't mean if the stock actually goes down from here, the current price, and if it starts going down, that does not mean we don't lose. It's going to have an unrealized loss. Now remember, when you actually do a trade, you always want to ask yourself, what's the delta? So if this stock goes up $1, down $1, the profit loss moves by about $3.88-ish for every $1 up or down. The verticals kind of stay more even as far as delta-wise because you got a long position, you bought it, and a short position. And those the deltas stay pretty close, okay? So that delta, it can move. It's not always going to be 3.88. It can move, but it's probably not going to move dramatically, okay? Now, when I say dramatically, I'm talking about the net between the short option and the long option. Let's talk about a bad trade for just a sec. What is the bad trade? Now, we talked about a collar position for just a sec. I want to just take 3 minutes on this. Bought the shares of Uber, and how many of you think this is valuable? Talking about a bad position, okay? Now, before I kind of make it sound all doom and gloom, the position is down $390, and it's down $390 on a portfolio that's at 112,345. Now, is this going to like completely knock our confidence in trading in general? That's it, okay? I'm not sure if I can do it. It's literally down 0.3%. The reason why you like to put things in percentage is you can kind of like whether you're trading a smaller dollar account, 50,000, 75, 25, 100, 400, whatever it is. That way you can kind of gauge it better. Dollar amount is deceiving because you don't like, I mean, if I said $500, but I told you I have $10 million, it's not that much. If I said $1,000 on a $20,000, that's a lot compared to what's in the account. So you don't really kind of know, the dollar amount's not telling everything until you see what the percent is. Now, let's kind of take a look at this for just a moment, what we talked about. We have 15 days left to expiration, okay? Now, the stock, look at where the stock is in relationship to the long put strike. Repeat, we said if the stock within 4 to 10 days before expiration is below the long put strike, what would the paper money account consider? Holding the position? Rolling the put? Never said that. Okay, what did we talk about? We said, hey, if the stock price is below the long put strike, the trend could have changed. If we're 4 to 10 days before expiration or in the week of expiration, if that stock is below that long put strike, the investor might consider ejecting all of it. Exit the collar, sell the shares of the stock. This is an example where the stock has not gone up. Matter of fact, it's gone down. Now, the one thing that could be done potentially is when the stock actually goes down, the put tends to increase in value. Okay, tends to. Okay, it kind of know like, well, how long did it take to go down? What's the volatility been like? That can affect the value. So some of the gains are on the put itself. Now, a lot of investors say, look, I just want to take the gain and make myself feel better. Well, be careful when you do that, because that long put is the life jacket to the shares of the stock. What do you mean by that? Well, remember that buying the put, that's a right to sell the shares at 92.5. So we're trying to use the 92.5 as a way to protect the shares. Now, what could the investor do? If the stock actually goes down, well, the call values typically go down. They burn time decay, and you also, for example, if the stock actually drops, there's a lesser chance of the stock being above the strike at expiration. If that's true, the market value drops. Now, what might the investor consider here? Well, they might say, look, what I'm going to consider, could we maybe roll the call? We're at 51% of that. Now, think of that $1.06, $1.04 as a way to reduce theoretically the average price of the stock. So we bought those shares at $95.83, less than $1.05. So it's like we own the stock at $94.78. If we own the stock theoretically at $94.78 and we have a right to sell those shares at $92.5, the losses are narrowing, right? So what we're going to do in this case is we're going to roll that call. So how do you roll the call? Right click on that line. Why are you going to roll it? Well, you got 50% of it. The investor, you can only make what you sold it for, and it's already gone through half. The thing is, if the investor doesn't roll it, the delta becomes smaller and smaller, so the gain you actually make, et cetera, is not as big. Theta is 9 a day-ish and could get bigger as you actually get closer and closer to expiration, given that you don't let it fall all the way down to 0. We're going to right-click on that, create a rolling order. Now this right here where it says calendar, it just thinks that we're going to do the exact same strike. We're not. We're going to do the exact same month, but we're going to change the strike. Okay, now if we're at the 97.5 call, we're going to go down to the 95. Now, you got to kind of think about this just real quick. What did you buy the stock for? Well, 95.83. So now you're agreeing to sell it at 95. You got to be careful. There's like a limit to this, okay? We're not selling at 90, because if you agree to sell the shares at 90, that's lower than what you own it for, okay? So we could probably typically only roll the call typically once. That's it. We're going to right-click, create a rolling order, sell. Now let's step back for just a moment and think, okay? The stock goes down, the stock is losing money. Okay, I get that. The stock goes down pretty quickly, the put increases in value. Well, of course it does. It has a great chance of being in the money. Okay, I understand that. What are we using the put for? It's a life jacket to the stock. It's the right to sell the shares at the strike price. What about that call? It's sinking in value. Could probably roll the call once, which we're doing now. And what we're now going to do is we're going to go to that 15th. We got to make sure that we're selling the same expiration. I want it to match what we currently have. This is the 97.5 call that we have now. We're just going to say, look, could we go down to the 95 and sell that one? Now, if we look at the 15th August, what are those 95s, what are they going for? Answer, they're going for about $1.55-ish. So one of the most overused language in the online course is consider rolling if you can do so for a credit. Okay, just so happens you could roll for a credit. We're going to do that, confirm send, note the commission, and send the order. And what we're now going to do in that case is we're going to try to roll from the 97.5 to the 95. Now, if someone asks us the question, yeah, but what about the position? Repeat. We got about another 10 days to see if the stock can recover. If it doesn't recover, okay, it's going to be sold. The call is going to be exited. The shares are going to be sold. Why? Well, because if you close below that long put strike, probably tells us, do you really want that trend? You go back and really look at, let's say, the stock chart and say, I mean, if we kind of close down much lower than where we are now, okay, we got to now question, is this trend changing? Well, I want to get rid of the long put and see if it's going to bounce. You got earnings coming up. Might want to reconsider that. Okay? Now, if this stock goes up, is this a bullish strategy? The answer is it is a bullish strategy. It is. Okay? Yeah, so at least on this, I'm not going to go to September. I'm going to try to keep, if there's losses, they're going to try to be kept in the 15th August expiration and not kicking the can down the street. Okay? Meaning rolling out to the next expiration. If it's a loss, it's going to take a loss. Okay? Here's the thing. We fall in love, or we try to get rid of all the losses. This is 0.3%, and there's so many other things that could be done, okay? Meaning so many other stocks that have a stronger trend. Speaking of that, and so here's the thing we need to understand, and I want everyone to say this out loud. I will have some losses. Say that out loud. I will have some losses. Say it out loud. I will have some losses. I can't hear you. I need a little louder. Little louder. I'm not hearing anything. Okay? So here's the deal. When people say, no, I don't have losses. Okay. The thing is having calculated losses. Okay? So that's the key. Now what I'm going to do is I'm going to go back to, let's say, a stock that we talked about before, DoorDash. Okay? Now the thing is, again, it's not that we're not going to have losses. I just want the losses to be smaller within the confines of what we said the paper money account was willing to risk. Were we just saying that, or do we really mean that? Okay? I just don't want to take losses. Look, we got to get outside the academia of if we're wrong at all, okay, it's bad. You want to recognize as soon as possible when you're wrong and know what the risk is. Do we have to be so worried about what Uber's doing and that's going to move the account overall? No, it's defined risk. It has a delta of 8. It's just very small. There's more upside than there is downside. Okay, that's why we're just going to let it play out. Now we got a trade on. We got a situation on Dash where we have a little if we're talking about an upward trend. And let's go back to that second chart from the end. You're going to see that one of the things we talked about last week was, let me ask you a quick question. If you were to go back and talk, Rich, if you talk to yourself, AP514, Kevin, Ray, if this was like Back to the Future and you were Doc and you were talking to Marty and you as Doc talked to Marty and you said, hey, I've been to the future. You need to now know this as you go from where you are presently into the future. One of the things we actually talked about last week is kind of the 10-period moving average. That is the foundational practice, whether we're talking about fundamentals / technicals. When we actually take a look at this, and so the question I want you to kind of think about is, what do you wish you would have known before, and what are you doing about that now? Speaking of that, what we're going to do is, now, some investors, what they like to see is kind of these, where the candles are above the 10-period moving average, the blue line. They also like to see maybe the pullbacks shallow. Shallow would actually be orange candles. Shallower would actually be orange and purple candles. Deeper pullbacks would actually really be orange, purple, red candles. But if we're only getting the kind of these orange and purple so far, there's been a history of shallow pullbacks. That kind of means that there's momentum and there's a little trend there. Now, we don't know what the future is going to bring. That's why you position size and you calculate the risk. Speaking of that, what we're going to do in this case, in a last minute here, we're going to come back into Dash and we're going to look at the 19th September and we're going to look and see, are there any options? And we're going to try to be a little bit more conservative over earnings. A lot of people kind of think that, oh, I'm always going to pick the same delta. You don't have to. You can start with a range and then look and see, is there liquidity? The last trade we're going to focus on here is selling the 230 and then buying the 220. Okay? So the 230, 220, and that is really going to give us an ROR there of about 30-ish%. I'm rounding. But that's going to be our last trade here. This is going to be a trade where it's trying to hold over the earnings, okay? So that'll be our last trade there. Now, I want to give us a quick reminder. You do not have to think that, oh, these are just live only. This class is being recorded. You can go right to our playlist. Second, you can also go right to our channel, okay? And if you say, James, when you're not teaching, where are you? I'm on X, okay? I'm watching the markets, and I share with what I'm seeing right on X as well. I want to also give you a quick reminder that coming up, you can also see our webcast schedule right here. And there is a feedback survey today. If you could please fill that out. Thank you in advance. Now, coming up next, we're going to have a class on short verticals by Connie. And then after that, Think Script Studies by Ben Watson. I'll be back tomorrow morning with Kevin. Remember, talking about ETFs. Remember with what we discussed, it was done for example, illustrative purposes only. Remember that all investing involves risk. Thanks to Brent, and stay tuned for Connie coming up next. This has been the class on Trade the Trend. Take care. Bye-bye.